Welcome to Advanced Trading Robots. This is part 2 of a large multi-part course. Before we begin, let us look at what we have learned in part 1. And next, we will talk about what we will learn in this course. Part 1 of this multi-part course is called Build Your Trading Robot. So here are some learning objectives of the first course. We will go through each of them briefly. For those of you who have taken the first course, think of it as a quick recap. First learning objective. Understand what is an algorithmic trading strategy and how to code them. So we learned that an algorithmic trading strategy, a low frequency one, is simply an automated way to analyze, backtest, optimize, and trade. In our course, the strategies that we look at are low frequency, based on math models, using a market prudent approach. So the types of strategies could include strategies related to macroeconomic factors, statistical methods, fundamental methods, and the design concept of these trading robots that we learned can be applied to different asset class. Although in the first course, we focus more on FX because there are less complications in terms of coding. We will talk about other asset classes in a future course. Parts of a strategy, 3 main part, an entry, an exit, and our position sizing. So we learn how they work together, how do they affect each other, and how to code them. And of course, we understand that the holy grail of an algorithmic trading strategy is the trader himself. There is no such thing as a set and forget strategy, something that you can leave there for many years and it will generate profits for you indefinitely. We learned that our strategies have to be market prudent. This means that they should rely on some sort of fundamental underlying market logic. And what we are looking out for are persistent market inefficiencies. We talked about robot design theories, such as are entries more important or are exits more important? And what does the stop loss really mean? Asymmetrical rules, how to model transaction costs, the difference between trading higher versus lower time frames, and how to set up adaptive components in our strategies, etc. We looked at the relevant statistics, such as our statistical significance and the law of large numbers, and we learned how to use them to analyze our strategies. We learned how to manage and code an algorithmic strategy robustly. So we talk about order management, how to manage different orders, market orders versus pending orders, single position trading strategies versus multi-position strategies, how to manage trading stops, how to create volatility trading stops, adaptive volatility trading stops, etc. And of course, we learned how to code in a way that protects ourselves against unexpected situations. For example, we limit trading when there is too much volatility in the market. We look at a very important point, data management. Remember, garbage in equals garbage out. If we have dirty data, our backtest results are inaccurate and therefore not useful. In fact, it will be detrimental because we think that our strategy is profitable, but it is not. We talk about different data sources, how to clean data, and how to manage data for our strategies. And most importantly, we looked at the big 3, our framework for building strategies. We start with idea generation. We talk about what to expect from our strategies. the different kinds of equity curves and what they mean. We talked about preliminary research, where to get ideas, how do we know the ideas are good or not. We talked about where to get ideas, how to validate our ideas, how to filter and vet through them, and identify those with potential. And we looked at how, as a retail trader, you can compete with the big boys, hedge funds, asset management firms, etc. Backtesting. Some people might say backtesting is a process where we just picked a time period from the past, run your strategy through it, try to find the so-called correct parameter values, and once you can find parameter values that lead to profitability, and that's it, you trade it. But no, backtesting entails understanding. What we're trying to do here is to understand the strategy. We want to know when it works or doesn't work. And if it works, we want to know why. Similarly, if it does not work, we want to know why as well. We talked about different market conditions and to understand when does our strategy perform. And we looked at strategic market conditions. This entails market conditions with certain characteristics that enable our strategy to work. We talked about robustness. 4 types of robustness in our backtesting chapter. Time frame robustness, period robustness, instrument robustness, and seasonal robustness. We looked at how to select parameter values for our trading strategy. What is the butterfly effect during backtesting? And how do we validate or grade our strategies? How do we know if they pass or fail the backtesting phase? The third part of the big 3, optimization. Optimization refers to maximizing performance while minimizing curve fitting. So we learned about how to define performance. What are robust objective functions? We learned about curve fitting and the 10 ways to reduce curve fitting. We look at how to break apart the optimization process using independent variable optimization. And of course, how do we analyze the results of the optimization, aka our parameter space analysis. And of course, our 4 robots, Adeline, Belinda, Clarissa, and Desiree.